Preparing for a financial advisor at Morgan Stanley interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial advisor at Morgan Stanley? Morgan Stanley combines a top-tier wealth management franchise with institutional research, lending, alternatives, and digital planning tools. I'm drawn to the financial advisor role because it is entrepreneurial but still disciplined by a strong platform and brand. I want to build long-term relationships by translating complex markets into practical advice. For Morgan Stanley, that means serving clients holistically: investments, liabilities, estate considerations, taxes, and goals, not just product recommendations. While answering, focus on Morgan Stanley's wealth management platform, entrepreneurial nature of the role, client relationship depth, planning-led advice, and why the firm's brand, research, and resources fit your career goals. Question 2. How would you build a client book during your first 12 months? I'd treat the first year like a pipeline-building campaign. I'd define a niche, such as young executives or business owners. Then create weekly targets for introductions, seminars, LinkedIn outreach, and centers of influence. I'd track every contact in CRM, follow up with relevant insights, and ask for referrals after delivering value. Activity matters, but credibility matters more. So every touchpoint must feel thoughtful and compliant. Make sure to cover prospect segmentation, daily activity targets, referrals, centers of influence, CRM discipline, compliance-aware outreach, and how you would convert conversations into planning meetings rather than product pitches. Question 3. Walk me through how you would conduct a first meeting with a prospective client. I would not open with a portfolio recommendation. I'd start by learning why they agreed to meet, what concerns them, and what they want money to accomplish. Then I'd ask about assets, liabilities, income, taxes, family obligations, career plans, and prior advisor experiences. I'd summarize what I heard, identify gaps, and propose a planning follow-up. The goal is to earn trust by diagnosing before prescribing. In your answer, talk about discovery before advice, understanding goals, liquidity needs, family dynamics, current assets, liabilities, risk tolerance, time horizon, and ending with clear next steps. Question 4. How do you assess a client's risk tolerance? Risk tolerance is partly emotional and partly financial. I'd separate willingness to take risk from capacity to take risk. A wealthy retired client may have capacity but panic in downturns. A younger client may tolerate volatility but need liquidity soon. I'd use Morgan Stanley's planning tools, structured questions, and scenario discussions. Then I'd document the client profile and connect it directly to asset allocation, rebalancing, and communication expectations. Be sure to mention qualitative and quantitative assessment, capacity versus willingness to take risk, time horizon, liquidity needs, behavioral reactions to volatility, suitability, and documenting the rationale for recommendations. Question 5. A client calls during a market sell-off and wants to liquidate the entire portfolio. What do you do? First, I'd acknowledge the client's concern instead of jumping into data. Then I'd revisit the plan, time horizon, income needs, cash reserves, and what the portfolio was built to withstand. If the sell-off doesn't change their goals, liquidating may lock in losses and damage long-term outcomes. I'd discuss partial de-risking only if circumstances changed. The key is calming emotion while staying grounded in the agreed strategy. While answering, focus on empathy, avoiding emotional trading, revisiting the financial plan, liquidity buckets, historical context, rebalancing opportunities, suitability, and documenting the conversation without dismissing the client's fear. Question 6. Tell me about a time you handled rejection or a difficult sales situation. In a prior sales role, I lost a prospective client after several meetings because I had focused too much on features and not enough on their real concern, implementation risk. I asked for feedback, adjusted my discovery questions, and started confirming decision criteria earlier. My conversion rate improved because I listened better. As an advisor, rejection is part of the job, but every no should sharpen your process. Make sure to cover resilience, learning from feedback, maintaining professionalism, follow-up discipline, measurable improvement, and why repeated rejection is expected in a financial advisor career. Question 7. How would you earn trust with a high net worth prospect who already has an advisor? I would avoid attacking the existing advisor. Instead, I'd offer a second opinion conversation focused on blind spots: concentration risk, tax efficiency, liquidity, estate planning, lending, or family governance. High net worth clients usually switch when they see a gap, not because of a generic pitch. I'd demonstrate Morgan Stanley's planning depth and institutional access, then follow up consistently. Trust comes from insight, discretion, and patience. In your answer, talk about differentiation without criticizing competitors, identifying unmet needs, planning depth, institutional resources, second opinion reviews, discretion, patience, and relationship building over immediate asset transfer. Question 8. What does acting in a client's best interest mean in this role? Acting in a client's best interest means recommendations must be aligned with the client's objectives, risk profile, time horizon, liquidity needs, and costs. Under Reg BI, I'd need to understand the investment, disclose material conflicts, avoid placing compensation ahead of the client, and document my reasoning. It does not mean every recommendation will outperform. It means the process is client-centered, transparent, and defensible. Be sure to mention regulation best interest, suitability, disclosure of conflicts, reasonable basis for recommendations, documentation, client objectives, and the difference between selling a product and giving advice. Question 9. How would you explain asset allocation to a client with limited investment knowledge? I'd explain asset allocation as deciding how much of the portfolio belongs in stocks, bonds, cash, and other investments. Stocks can drive growth, bonds can add income and stability, and cash supports near-term needs. The mix should reflect the client's goals and risk tolerance, not market headlines. Over time, winners and losers shift the mix, so rebalancing helps keep the portfolio aligned with the plan. While answering, focus on simple language, diversification across asset classes, risk-return trade-off, matching allocation to goals, rebalancing, and avoiding jargon while still sounding technically credible. Question 10. What questions would you ask to uncover a client's real financial goals? I'd ask questions that move beyond returns. What does financial success look like for you? What worries you most? Are you supporting family members? When do you need liquidity? How do you want wealth transferred or used? I'd also ask what worked or frustrated them with prior advisors. The best goals often emerge after the client explains trade-offs, not after a standard questionnaire. Make sure to cover open-ended discovery questions, goals beyond investment returns, family responsibilities, retirement lifestyle, legacy, liquidity, tax concerns, risk fears, and prioritizing competing objectives. Question 11. Describe your investment philosophy. My philosophy is planning-led and risk-aware. I don't believe most clients win by constantly timing markets or chasing last year's best asset class. I'd start with goals, then build a diversified portfolio that balances growth, income, liquidity, taxes, and downside tolerance. Active management, passive exposure, and alternatives can all have a place if they solve a client need. The portfolio should serve the plan, not the advisor's ego. In your answer, talk about disciplined planning, diversification, long-term compounding, risk management, cost awareness, tax awareness, avoiding market timing, and adapting to client-specific goals rather than one-size-fits-all portfolios. Question 12. If a client wants to move entirely to cash because of negative news, how would you respond? I'd separate the emotional reaction from the financial decision. Cash feels safe, but it carries inflation risk and the risk of missing sharp market rebounds. I'd review how much cash the client actually needs for spending, emergencies, and near-term goals. If their plan already has adequate liquidity, going fully to cash may be a market timing decision. I'd suggest measured adjustments only if their circumstances or objectives changed. Be sure to mention behavioral finance, opportunity cost of cash, inflation, missing market rebounds, liquidity reserves, staged adjustments, and using the client's written plan as the anchor. Question 13. What would you do if a client requested an investment you believed was unsuitable? I'd first understand why the client wants the investment. Maybe they heard about it from a friend or are chasing a return target. Then I'd evaluate it against their risk profile, liquidity needs, concentration, time horizon, and experience. If it appears unsuitable, I'd explain the risks clearly and propose alternatives. I would document the conversation and escalate if needed. Protecting the client and the firm comes before completing a transaction. While answering, focus on fiduciary mindset, suitability analysis, educating the client, documenting concerns, offering alternatives, escalating when needed, and being willing to decline a transaction if inappropriate. Question 14. Explain the difference between a fee-based advisory account and a commission-based brokerage account. A fee-based advisory account typically charges an ongoing percentage of assets and is designed for continuous advice, monitoring, and portfolio management. A commission-based brokerage account generally charges when transactions occur. Neither is automatically better. A client who trades rarely may not need an advisory fee, while a client needing ongoing planning and active oversight may benefit from advisory. The right choice depends on services provided, expected activity, costs, and conflicts. Make sure to cover how advisors are compensated, ongoing advice versus transaction-based service, client trading frequency, cost transparency, conflicts, suitability, and matching account type to client needs. Question 15. How would you position Morgan Stanley versus another wealth management firm? I'd position Morgan Stanley as a firm that combines personal advice with institutional capabilities. Clients get access to strong research, planning technology, capital markets insight, lending solutions, alternatives, and a global brand. I wouldn't claim Morgan Stanley is right for everyone. I'd connect the platform to the client's specific need, such as concentrated stock, liquidity planning, business sale proceeds, or family wealth transfer. Differentiation must be relevant, not generic. In your answer, talk about Morgan Stanley's global brand, research capabilities, financial planning tools, alternative investments, lending, investment banking connectivity, digital platform, and integrated service for affluent clients. Question 16. How would you balance prospecting, client service, and administrative responsibilities? I'd run my week with structured time blocks. Prospecting needs protected hours because it is easy to postpone. Existing clients need service standards, especially around reviews, follow-ups, and market events. Administrative and compliance tasks should be handled promptly, not saved for crisis mode. I'd use CRM to track next steps and delegate appropriately within the team. The best advisors combine high activity with consistent process. Be sure to mention time blocking, prioritization, CRM usage, service standards, delegation to team resources, compliance deadlines, and building repeatable routines rather than reacting to every task equally. Question 17. How do you use referrals and centers of influence to grow your practice? Referrals work best when they are earned, not forced. I'd build relationships with CPAs, attorneys, bankers, and business brokers who serve similar clients. I'd share insights, be responsive, and show that introductions will be handled professionally. With existing clients, I'd ask for referrals after solving a meaningful issue or delivering a strong planning experience. The goal is to become easy to recommend because my process is credible and client-centered. While answering, focus on earning referrals through value, building relationships with attorneys, CPAs, bankers, and business brokers, maintaining reciprocity ethically, and avoiding aggressive referral asks before trust exists. Question 18. How would you contribute to a team of senior financial advisors? I'd start by making the team more productive. That could mean preparing planning materials, researching prospects, organizing follow-ups, supporting review meetings, and tracking pipeline activity. I'd listen closely to how senior advisors frame questions and handle objections. Over time, I'd earn client-facing responsibility by being reliable, prepared, and compliant. A strong junior advisor does not just ask to learn. They remove friction for the team. Make sure to cover humility, learning mindset, prospecting support, financial planning preparation, meeting follow-up, market research, client service, compliance awareness, and gradually earning more client-facing responsibility. Question 19. A business owner just sold a company and received a large liquidity event. How would you approach the opportunity? A liquidity event is not just an investment opportunity, it is a planning event. I'd first understand taxes, spending needs, family goals, charitable intent, and the owner's emotional transition after the sale. I'd likely recommend staged deployment rather than investing everything at once, while maintaining cash for taxes and near-term needs. Morgan Stanley specialists could help with estate, lending, and alternative investment considerations. The objective is preserving flexibility while building a long-term plan. In your answer, talk about discovery, tax considerations, cash flow planning, risk reduction, concentrated wealth, estate planning, charitable goals, staged investment, lending needs, and involving specialists when appropriate. Question 20. What is your current market outlook, and how would you discuss it with clients? I'd give a balanced outlook rather than a bold prediction. I'd discuss the main drivers: inflation, interest rates, earnings growth, valuations, and geopolitical risk. Then I'd connect those views to client positioning, such as duration in bonds, equity diversification, cash levels, and rebalancing opportunities. I would also be clear about uncertainty. Clients need context and discipline, not market entertainment. The outlook should inform the plan, not replace it. Be sure to mention balanced views, avoiding overconfidence, connecting outlook to client portfolios, inflation, rates, earnings, diversification, risk scenarios, and using Morgan Stanley research without making unsupported predictions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.